resurgence here.
Welcome to On the Record, a webinar series from Vinyl Equity, hosted by Rob Schoder. Today we discuss the path to public, the state of the public markets. We will get insights from Jack Cassel, who is the Senior Vice President and Head of Listings for the Western United States at Nasdaq. We hope you enjoy this conversation, and Rob, now over to you.
All right, everybody. Welcome to Vinyl Equity on the Record. This is our fourth installment to the webinar. My name's Rob Schoder. I'm the CEO and co-founder of Vinyl Equity. For those that may not be aware, Vinyl is the first novel transfer agent technology for public companies introduced to the market in almost 30 years. Today, we are going to be discussing the evolving path to going public with Jack Cassel, who oversees listings for the West Coast for Nasdaq. Obviously, the last, 12 to 18 months, it's been a pretty fluid situation on the path to the public markets. And so it'll be very exciting to hear from him. Jack, I'm going to hand it over to you to introduce yourself. And for anybody watching, please don't think twice about the fact that we're matching today. That was unplanned. So Jack, I'll hand it over.
I appreciate it very much, and thanks again for having me. So as you mentioned, I'm a Senior Vice President here at Nasdaq and head of our listings business for the Western US. So that essentially means working with all the private companies that are on the path to eventually listing or an IPO. To the public markets, and then also the client management, working with all of our incredible public companies post IPO and continuing to support them throughout their life as a public company.
And so, in your role, Jack, you're responsible for not just the go-to-market and commercial side of things on this from a sales perspective, but also account management, operations, and everything in between, compliance, regulatory, for everybody post IPO. Is that a sufficient summary?
That's correct.
Okay, great.
You got it.
Awesome. Well, Jack's team has overseen some pretty massive IPOs as of late: Chime, eToro, Omada Health, and CoreWeave, to name a few. Very candidly, from our world in the fintech space, we've heard a lot of talk about the rebirth of fintech, and that's been pretty exciting to watch. Jack, if you've got any reflections on the last few months and some of these recent successes, I'd love to hear from you on them.
Yeah, I think, first I'll start with we're so excited for these companies that have been able to get out, and especially this most recent cohort that you named, that have all traded well and had incredible day ones and celebrations, but then those subsequent trading days. And so, with each of these, I think one of the trends we've been seeing is, one, every one of them has been prepared to go public. So they started this process much earlier. Obviously, we had the trough over the last few years, but when the window was there, they felt the operations and their narrative was ready for prime time, if you will. They had the investor feedback and really checked all those boxes. They felt that it was time to go, and again, it was just very exciting to see them perform well and to get out and have that success. I think one of the key elements to that is the advisors and the banks specifically through this market have priced these deals well. I think that's always the art and science of an IPO, right? Is kind of the valuation. What was the private valuation? What do you want the public valuation to be? Where are your comps, right? All the math that goes into that valuation and then pricing the actual deal. But they seem to have gotten it correct, at least in the last few cases. And so hopefully that playbook is sustained and repeated for the next cohort that's looking to come to market. And I think too, as you look at each one of these on an individual basis, they do have incredible stories. They do have specific KPIs to their models that they're indicating to the investors as well as the analysts. And then, most of them are mission driven. And so there's an overlying theme of, why they go to work every day. Here's our model. Here's how we're executing to plan. Here's our visibility into revenue for the next, 4 to 6 quarters, and how we'll continue to execute to that. And that all bundled together has given everybody a sense that these are great companies and ones to invest in.
So I want to key in on something that you just said, because I think you made an interesting point that all these companies are extraordinarily well prepared for their debut here. And I'm curious to know what your thoughts are on this, because most of these companies kicked around the notion of going public back in, we'll call it the boom times, right? And then obviously it's been a little slower over the last couple of years. But are you seeing that this has given companies a platform or almost a foundation that is much more solid in terms of their storytelling, in terms of the way that they position themselves, they plan and they build process internally in advance than, any time over the last, call it 10 years or so? Or, how do these companies look different today, given that historical context, than they have?
Yeah, I think you nailed it in the sense of really that preparation. And we've seen kind of those best practices. Companies are starting their process 12, 18 months in advance. And for some of the larger scale companies, even 2 years in advance. They're soft circling a date. Maybe it's a loose, hey, Q3 25 or Q3 even now 26. We want to be ready to be a public company by that time. And then they work backwards from that date. What do we have to have in place from an operational standpoint? So as you think of kind of the readiness with your systems, with your HR and ERP, how quickly can you close the book? So there's that kind of accounting element. There's getting the audits done. But then on the capital market side specifically, it is starting to meet with investors well ahead of your eventual roadshow. And I think that's been a kind of a maturity in the market over the last few years, where you go back to 20 and 21, again, all-time high watermarks in the IPO market, but companies were spinning up maybe a non-deal roadshow or a TTW, testing the water. 6 months out, then they get some one-on-ones, hit the road, and they price the deal. Conversely, now starting that process earlier allows you, not only from a company standpoint, not only to meet with kind of a breadth of investors, both domestically, large institutional investors, but we're seeing a lot around the sovereign wealth for hedge funds, for family offices, but then also internationally. So it is a lot of work to go tell that story, but also you get this feedback loop. What are the KPIs that investors want to hear? What are their questions? What are the headwinds that they feel that you may face, that you may think you have a bulletproof story, but then you kind of get some one-off questions. You're like, well, if he or she is thinking that, maybe we need to have a data point there. And then how are we going to grow our SAM and our TAM if we only have X% now? How do we grow into that? And how do we face these incumbents, right? So just kind of that traditional diligence, but as the earlier you can start that process and get that feedback loop, it just helps you craft that story and be more confident in your story going forward. So when it's really kind of the lights are on and it's game time. And then I think the other leg of that stool is also with the analyst. So following your IPO, a lot of your coverage is going to be picked up by the research analyst. And so also starting to meet and interact with them in a similar fashion so that you have their feedback loop as well around your story. And that helps you as you kind of not only craft that story, but as you, again, get to a point in time where it's like, hey, we are a go. Now you have relationships, you have people that understand your story. They've been tracking you for the last year or so. They've been getting those quarterly updates. And then when it comes to the IPO, let alone post, they're hopefully more confident to come into your stock, take a significant allocation, and be long-term shareholders.
And you mentioned 1 to 2 years, and we generally, hear that companies are prepping sort of in this. That's when a well-run, well-structured process looks like. But a lot of these companies kicked around going public in 2021. And so they started to implement some of these processes early on, and they may have actually been carrying them forward for the last 4 or 5 years, waiting for the right timing. Are you seeing kind of more mature internal processes that have been battle tested over a period of time to mimic the public markets? Because that's what we hear so frequently, right? Is you should pretend you're a public company for 18 to 24 months in advance of being a public company. Is this crop, and maybe it's not a crop, maybe it's a tidal wave of companies that are getting ready to go public. Are they showing up looking more mature in that regard than they have, historically in your experience?
The answer is yes. And I think what we really saw, and kind of to use that data point of 21, right? There was, again, such momentum in the market, some incredible private companies that were at scale and likely ready to go. And then in early 22, we saw the market close, we saw inflation hike, and everybody, it was a risk-off environment. So everybody really pulled back to a large extent. And through that, we saw investors really pivot and reorient towards, versus growth at all costs. It was growth with cash efficiencies and a path to profitability. And so for the companies that are now coming out, are looking to come to market, are starting to prepare to come to market, the good ones that are still thinking about an IPO have taken those operational efficiencies, taken off the pressure of we have to be ready now because the window was closed, and said, okay, how do we also reorient our business? How do we scale this efficiently? Maybe it's not at 40%, but it's at 25%. But now we have a path to profitability. Do we offshore some elements of this? Do we leverage certain technologies? Obviously, we've seen this a lot with AI from an operational standpoint, kind of internally, let alone through their respective products. So how do we really take this new model to ensure that we are doing everything right as a business? And then through that, I think it also gave them time to say, okay, we feel like we're in a good place operationally. Now, how do we start to ensure that we are ready to be a public company? And I think you nailed it. And again, closing the books, some of the contractual agreements that they have in place, and in many instances, there's language in there. It's like, look, there's risk here in some of your just terms of agreement. Based on this, we need to update your terms of agreement going forward for you to be a public company. And then in a lot of instances, we see executive teams start almost mock earning calls and start to do Q&A and really, again, take it to that level of readiness or preparedness so that once they are ready to go, there's no questions asked. They are prepared to be a public company.
And that has an impact on your business as well, right? And so can you talk a little bit about how you think about pipeline and how it has caused you all to look internally at some of the solutions you're offering, and with companies staying private longer, whether it's a macro outcome or, it's related to how companies actually are viewing liquidity. Can you touch on that a little bit, and then we'll jump into a couple other things?
Yeah, sure. Well, I think in our seat, it's trying to be as supportive and additive as we can for companies going through this process. So there's a couple different ways that we'll engage and can be supportive. One, it starts, we do have Nasdaq private market. So that is something that was part of Nasdaq for a number of years. We spun that out in 21 into a consortium of banks, but still partner closely with them. So as these companies have stayed private longer, in many instances, they're looking to offer their employees secondaries. So it gives them an opportunity to have some liquidity while the IPO may have pushed out some months or quarters in the future. It allows them to attract and retain talent and release some of that pressure. And so that's been a great opportunity, and again, very beta to the public markets, but therefore, as we're seeing the upswing in the public markets, They're having a record year in volume for those structured liquidity programs. So that's been a great opportunity for us to add value and support the companies. Then two is a lot around best practices. We own and operate a lot of investor relation solutions. So how do we pull that forward from a data perspective to augment a lot of the great advice they're getting from banks and advisors as well? So we sit in this agnostic seat where we have troves of data and investor intel. So helping them to really think about that broader landscape and who should they be focused on with their respective meetings. And then obviously on the marketing side, we've got our 7-story tower there in Times Square. So, try to be as supportive as we can with certain milestones, certain new key hires, anything we can to help them amplify their story while still private.
Sure. Well, one of the things I've always appreciated about Nasdaq is that, Nasdaq as a business doesn't just view itself as an exchange or listings venue. You kind of view yourselves more broadly as a technology company, right? And as we've gotten to know you all, it's been really fun for us to see the way that you push the envelope from a technology and service offering or solutions offering perspective to some of your clients, and obviously the partnership with Nasdaq Private Markets and maybe the birth of is a great indication, but it also represents a pretty compelling almost hedge with the way the market is changing or shifting from a dynamics perspective. So that's good to see. And as you think about signals for the market opening up, we hear all the time in the media about VIX, and obviously we saw a little blip over the last couple of months in VIX spiking after a period of relative comfort. What other signals are you guys looking for, and how are you thinking about the back half of the year here as it relates to what those inputs are?
Yeah, I think the VIX is still a barometer just for volatility in the market. The 20 is really the key threshold that the markets follow as it relates to IPOs. 95% of IPOs go when the VIX is below 20. That said, we've seen that sitting at 20 or at 13 in some months or quarters, and they're not being deals. So it's a data point. And I think, the other indicators we're tracking is just the Fed movement right now, kind of the CPI and a lot of more of your macroeconomic leading indicators to see, trying to skate to where the puck is, because that really is indicative of the investor sentiment. And the investor sentiment, if they remain bullish and risk on, then they're going to have an increased appetite to create alpha and therefore look at IPOs or new issuers. And so there's not necessarily I'd say something unique to the way we view the world. We talk to as many people as we can, both, from the investor side to the advisory side to the companies themselves. I think in the end, it comes down to the companies themselves. Are they operating at the best of their ability and
Sure.
executing to plan? And if they're doing that, and then again, match that with the broader environment and then the expected valuation, and as those kind of converge, then we're going to see a lot of activity. And I think to your point on the timing front, obviously there's a lot of global elements going on right now that we're watching closely. But again, it's more from seeing how the markets continue to react to this. I think we will have 2 IPOs tomorrow, and then likely maybe a few in July, but just a few. August is typically dead. And then we really look at that post-Labor Day window, where as of right now, with the number of companies that are on file confidentially, that are starting to prepare, we do expect a significant increase for this fall in that kind of late September, October timeframe.
Sure. So I want to shift gears a little bit and talk a little bit about technology, operations, and process. In part because Vinyl, as a business, as a transfer agent in the market, has taken the position that this is the transfer agent market is extraordinarily antiquated and represents a point of friction in the process of both going public and just being public, frankly. As you look at the process of going public, given that you all are a technology-led organization and you do quite a bit of venture investing actually through the Nasdaq Ventures arm, can you talk a little bit about points of friction in the IPO process that you think are ready to be disrupted or need to be disrupted as the market, continues to evolve and as maybe different stakeholders in the market expectations start to shift?
Yeah, it's a good question. It's probably $1 billion question. Hence why you started Vinyl, of course.
Yeah, right. That's right. That's our hope.
Yeah. I think it's an interesting dynamic in the IPO market because it's such a traditional path to the market. And I think as we look back over the last few years, we saw certainly the evolution of the direct listing, and it does feel that that's certainly a bull market kind of product or vehicle. And my sense is we'll start to see that come back again for the right companies that are a bit more of a ubiquitous name that don't need the capital per se and may elect to do that path. And my sense is probably 26, just given to the kind of the attributes of doing that path versus the risk. So I think that's one that we've seen, and I think one again that'll come back. I think also we've seen the SPACs. We saw the SPAC craze in 20 and 21 was that had always been around for 25 years, and we had always seen about 30 to 40 new SPACs, but it was this small group, concentrated group of sponsors that had executed these. And then it became this new opportunity and vehicle to get companies listed in public. In 2021, there were over 600 SPACs that listed. So we did know that other shoe was going to drop, but year to date, there's been 55. So we're starting to see a bit more of an emergence there. Sure. So I think from a friction standpoint, as we survey the markets, it really comes down to ensuring that you have, it's just any deal, right? The supply, which is going to be the companies, but then that demand. I think we've developed a proprietary technology through the opening auction that helps to make that a very seamless transaction itself. So the whole book building process, bringing in all the bids and the ask, and kind of gives you that aggregate view. And this sits on the desktop of the company syndicate so that they can actually see where the orders are coming in and really layer the book. So it's something we've invested in heavily and knock on wood, have been successful in leveraging to transact, thousands of IPOs. And so I think that's something that we did see in the market that we invested in and developed in partnership with the investment banks. That has made it a bit more seamless for companies going through the actual first trade process. And then I think for the public companies, again, we're working closely just around kind of just capital formation and really trying to ensure that it's feasible and there's an ROI on being a public company. It's not necessarily easy given kind of the regulatory environment today for companies, especially at the smaller scale, more your small cap and even your micro cap. These are in many instances great companies that are going public. However, then they're met with kind of all the disclosures, the proxies, and the various other elements of being public. So I think there's likely whether it's a technology solution or something broader that can be solved for to make it easier for companies to be a public company post IPO.
You touched a little bit on some of the regulatory side of things. I think there's plenty to be done on the technology side, whether it's by leveraging data more effectively or artificial intelligence, and we'll see where things take us in that regard as it relates to insights. From a regulatory perspective, you touched on some of the complexity around there. Are there things that you see companies typically not ready for, or that you would recommend that companies, as they're prepping to go public, might look out for, either in the regulatory or operational and process side of things, that you want to include a plug to say, hey, this will serve you well on a go forward basis? And then if there are any things that you might speculate would make it easier for companies from a regulatory perspective, I'd love to hear your thoughts on that.
Yeah, I think I'd answer two ways. So one, just just thinking about what they're not necessarily ready for. I think in a lot of instances, as we talk to companies or executives going through the process, it'll be around their investor relations kind of program and structure, right? So that is a full-time job. Companies that do it well, you get an experienced IRO or investor relations officer, or you bring somebody in from kind of the sell side that has a great group of relationships. But their job is to constantly be out in front, storytelling and engaging investors. And so we've developed, I mentioned this prior, but kind of our technology suite to support them in those efforts. So there's kind of the database and the CRM tool that allows them to have all the information in a single place, and then it pulls in the various data sources, so it becomes kind of this one-stop shop developed specifically for the IRO and their teams, so they have everything at their fingertips. And that, just like any technology, it drives the efficiencies for them to stand up, to launch and really execute a successful IR program. We also have services built around that, around surveillance, understanding who's buying and selling your stock, versus waiting for those 13Fs to come out 45 days after the close of the quarter. We can pull that forward to T+1. So we can reach out proactively to triangulate who's actually coming in or out of your stock, understanding, the passive investors, especially around ETFs, and really seeing, the amount of inflows into kind of the passive market, and understanding what are the exchange traded funds or products that you are actually listed in, and how much of your cap table is actually allocated or correlated to passive. And then on the flip side of that, understanding, are there activists coming into your stock? So again, leveraging technology to provide that data. And then on the regulatory standpoint, again, we work with our companies, survey them really on a quarterly basis to a large extent, if we're not engaging them on a weekly basis to a large extent from an account management or just our general relationship. But as we kind of conduct these studies, we are trying to identify what are those frictions, and then how can we really advocate on their behalf to the regulators to say, hey, of our 5,000 listed companies, here are some of those keys or key points of friction that we believe would really help, promote robust capital formation, support investor protection, and just continue to drive their innovation. And so there's a lot around, again, just I guess the two that kind of come to mind are disclosure relief and some of the litigation reform. And I think those are a bit outdated from my perspective, but we also have a white paper on this as well. That are two key things that we've heard. And then as you kind of dig into it, again, these are just very outdated policies that we think could evolve or change, at least on the margins, to make it a bit easier for companies.
Yeah, that's good context. Last question And then I'll ask for any parting thoughts. Do you see a movement from companies today as they're approaching the public markets to embrace more technology-forward service providers relative to some of the kind of old world service providers that may have dominated some of the capital markets?
I do. I do. And I think, it's the beauty of the capital markets, just broadly, and then kind of weave in the technical evolution. I mean, when you go back to the genesis of Nasdaq, right, in 1971, it was to electronify the stock exchange. Everything prior was just paper tickets and close at the end of the day and the yelling on the floor and the whole deal. And our founders thought that there was a better way to leverage technology to improve. And here we are in 2025, as a global exchange powering with our technology about 150 other exchanges around the world. And so I think to that point, I think a lot of where you sit in this market as well will be kind of the expectation of how can I leverage technology to drive these efficiencies versus the manual element of this or an antiquated process. And I think also that user interface and the UX and the UI, right? Everybody has their phone now. We go on our respective apps. Sure. And you want something that's clean and quick and zero latency, gives me the data, I can run my reports. And this, is applicable to a myriad of reports and things that executives are looking at. But having a technology solution that can solve those problems in real time and give them the confidence, I don't know any executive that wouldn't look at that and be excited to either try it or leverage that on a go forward basis.
Yeah, and I think that the confidence element is a critical one, and I think it comes it's almost implicit in automation and leveraging technology insofar as you eliminate the the opportunity landscape for manual error. And I would imagine a more integrated solution many folks are looking toward. And I don't think it's an option as we move toward a T0 or instant settlement world, right? You can't be waiting for somebody to, move some paper around in the back office. So that's great to hear. Any parting thoughts here, Jack, as we wrap things up?
I'd say, we're very excited for the outlook for specifically the IPO market. And I think there's an incredible cohort of companies that are preparing now, that are at scale, that are thinking about it, whether it be later this year or into 26 and even into 27. I think to your point, we're continuing to see the innovation cycles really increase in time to market and the efficiencies. And I think it's going to be a great story for investors, both institutional investors, but also for all of us retail investors. And I think, I'm fortunate in my seat at Nasdaq, especially on the West Coast, but any of my counterparts around the world would say this: we get to work with some of the most incredible companies in the world, both on the private side and specifically on the public side. And we're here to be as supportive as we can for any company and team going through the journey. We're fortunate to work with companies that have been through the process. We learn from each and every deal that is executed, and we look forward to kind of engaging and being supportive and helpful any way we can going forward. Amazing.
Well, Jack, thank you so much for taking the time to speak with me today. Again, everybody, Jack Cassel, head of West Coast listings for NASDAQ, and I'm Rob Schoder with Vinyl Equity, and this is another episode, I guess, of On the Record. So have a great day, and we'll see you next time. Appreciate it, Jack.
Thanks, Rob. Great job.
We thank you for joining us on this webinar, and we hope you enjoyed this conversation with Jack and Rob. For more information, please scan their QR codes or visit us at vinylequity.com. Please stay tuned for upcoming webinars. Join us on September 17th for a conversation with Brian Steele, Managing Director and President of Clearing and Security Services at DTCC. Follow us on our LinkedIn page for any updates on the past and upcoming webinars. We look forward to seeing you on June 17th. Thank you again, and have a good rest of your day.